Hi, welcome to this video. We're going to discuss now the exercises 1 to 6 of chapter 29, the monetary system. Remember, this is a book of Gregory Mankiw, Principles of Economics. So the first question says, which of the following are considered money in the US economy, which are not? Explain your answers by discussing each of the three functions of money. So first, before going to the ones that we are going to verify if they are money or not, we have these three functions of money. As a medium of exchange, so we can provide easily this as a way of payment, and the receiver will accept without any trouble. As a unit of account, you can measure everything in terms of the currency, the money that we're, or the amount can be considered in this specific unit of account, and store value can be used to transfer money from present to the future. So you are sure that if you have this money today, even tomorrow, it will be accepted. So those are the four instruments. So we're going to go to the first one, the US penny. So naturally, this is a medium of exchange. Obviously, it is almost worthless, but if you have like a bunch of them, you can buy something definitely. So this could be definitely a medium of exchange. Of a unit of account, yes, because the US penny you can count everything in terms of pennies. Obviously this is going to be kind of hard, so it should be easier in dollars, but anyway, this is a unit of account, and a store value can be used to purchase goods and services tomorrow. So then this is money. Mexican peso. Well, even if it is a currency, well, for the US economy standard, it isn't, because actually this is not a medium of exchange. You cannot go with Mexican pesos and pay your staff there. Maybe close to the border, you can make some payments in Mexican pesos, but even it should be so hard. Of a unit of account, yes, we can consider everything measured in Mexican pesos. As store value, definitely you can use this present to the future, taking into account that there is a risk of the currency, that this is going to worth less in the future. So there may be some risk associated, but beyond that, could be a store value. But for standards of US economy, Mexican peso is not money. Picasso painting. Well, as a medium of exchange, should be so hard that you go to the restaurant and you said, okay, I want this dish, this champagne, and I'm going to pay to you for this specific dish my Picasso painting. Well, definitely so hard to find exactly the same desires from the other side, so definitely it's not a medium of exchange. As a unit account, it's so hard to say that, for example, did a hamburger, it cost 1/10 of Picasso's value, so definitely it's not a unit account, but should be considered as a store value, because this Picasso painting, actually this is increasing a lot from one period to another one, okay, because of the scarcity, it's unique, recognition, so a lot of features that make these paintings so worth. So a plastic credit card. So if we're talking of just a plastic credit card, and we don't have like any money inside, it's just a plastic, so definitely it's not a medium of exchange. You need to find someone that is looking for a specific plastic credit card and want to receive you this one specifically for the good or service that this person is providing to you, which is definitely so hard. As a unit of account, so you need to compare all the other goods as a plastic credit card. It's so hard. And store value, well, if it's just a plastic credit card, definitely doesn't have any specific value per se. Second, explain whether each of the following events increases or decreases the money supply. So first, the Fed buy bonds in open market operation. So remember, Fed provides is the organism that regulates the economy and the quantity of money in the economy. It means the money supply. They have like different instruments to provide this specific service, and one is the open market operation. Basically, with the open market operation, when the Fed buys bond, what it makes, basically it goes to the market and then extract bonds from the economy, but as in exchange of taking this debt from the government, because those are the bonds that they're issued by the government, then provides money to the economy. So then it increases the quantity of money. The Fed reduces the reserve requirement. So then, when the Fed provide this reduces reserve requirement. So maybe some banks will have a lower ratio. Maybe not all of them, because maybe some of them they have like risk averse and they prefer to keep the reserves as they were before. But maybe some banks then will have a lower ratio, so then they will start like make some loans. Remember, the ratio is measured as reserves over deposits. If reserves go down, so then it traduces in more money to lend. So then higher money supply. C. The Fed increases the interest rate it pays on reserves. So remember, since 2008, Fed started to pay interest from the reserves. This is a key fact, because some banks they have then incentives to keep money in themselves, because they will receive even interest just for taking this money in your reserves. So then they have like, with an increase, banks have incentive to keep reserves, so less money to be lent, and then a decrease of the quantity of money supply. Citibank repays a loan it had previously taken from the Fed. So when Citibank borrowed this money, then at the end of the day, this money is taken out from money supply, because Citibank has now less money available to lend, because this money is going back to the Fed. So then the money supply decreases. Then after a rush of pickpocketing, people decide to hold less currency. So keeping all other stuff constant, and imagine that this is going to work as we are working in this chapter, so people start to go to the banks, and they have more money in deposits. When we have more money in deposits, then the banks they have more money available to lend. So then money supply increases. Fearful of bank runs, bankers decide to hold more excess reserves. So more reserves, it goes immediately to multiplier, because reserve is the reciprocal of the multiplier. So if the reserves is 10%, the multiplier is 10. So then in this case, we have like more reserves, which automatically it traduces. So for example, in this case, it affects the multiplier, because less money available to deposits, so then the money decreases, the money supply. G. The FOMC, which is the committee from the Fed that is in charge of monetary policy, which basically the objective is to keep the level of prices, or the inflation, the increase of prices, of general prices, in a determined target. So at this point, they have they increase its target for the federal funds rate. So then, when it increases, so we are supposing here like a higher interest rate, and it introduces less interest from banks to borrow money from the the Federal Reserve. So then they have less money available to lend. So then the money supply decreases. 3. Your uncle repays a 100 loan from 10th National Bank, TNB, by writing a $100 check from his TNB checking account. Use T accounts to show the effect of this transaction on your uncle and on TNB. Has your uncle's wealth changed? Explain. So first start with the 10th National Bank. So from one side we are going to put here our assets, and the other side we're going to put here our liabilities. So the assets will increase because of new deposits. Well, actually, yes, this one where you're going to have this available, 100, and then it's going to be an increase in these deposits, and then your loans, you can your loans that you have, they are going to decrease in 100 because was a debt that it was acquired before from your uncle, right? So, and actually the situation of your uncle is the same. Actually, I didn't put the situation of the uncle, but should be something like that. So you have here that your uncle before, she has here in assets, and here we have liabilities. So then in assets, this is going to be a decrease here because this is not money that you don't have anymore, and your liabilities will decrease as well because you don't have these payables. And actually now the situation is the same, just her cash diminishes and her payables as well. So 4. Beleaguered State Bank (BSB) holds 250 million in deposits and maintains a reserve ratio of 10%. So show a T account for BSB. Deposits, we have 250 millions, a reserve ratio of 10%. So this is the BSB situation. We have from one side assets, from the other liabilities. So reserve is going to be this 10% of these 250. So your reserves, they are going to be 25, and the deposits should be 250. This should be the liabilities that they need to pay, and then the loans, the available, should be naturally the remaining 225. B. Now suppose that BSB's largest depositor withdraws 10 million in cash from her account. If BSB decides to restore its reserve ratio by reducing the amount of loan outstanding, show its new T account. So then basically the reserves will decrease in this situation minus 10 because this is the money that I had available, and I had, or this bank had to provide to the largest depositor. From the other side, the deposits that they need to repay, because this part of liabilities decreased from 250 to 240, and then the loans that we had before 225, they remain the same because this is the money that I have a receivable. Then I have this one, the reserves, it reduces to 15 and deposits to 240. Then I know that the 10% of the deposits that I have 240 should be exactly 24. So then I need to provide to the reserves plus 9 in order to achieve this 24, and I need to decrease our receivables or our loans from 225 to 216, right? So then as a consequence, this should be the situation. Next, explain what effect BSB's action will have on other banks. Well, the BSB does not lend the same quantity of money because it recovers it in order to put more money into reserves. So then this is a reduction on deposits of other banks. So, and actually the other banks, if they need to fulfill the requirement service, they will do the same as BSB. And then there should be definitely a decrease in money supply. D. Why might it be difficult for BSB to take the action described in part B? Discuss another way for BSB to return to its original reserve ratio. Well, actually, I guess that you wonder about this one because actually your loans cannot be like rapid or fast in a specific period of time. You cannot say just like at once, I need more $9 million more, so I'm going to recover from my loans, because naturally I have already signed contracts with people that the borrowers, and they are going to pay as the contract establishes. If the contract establishes that I need to pay 1 million each month, so definitely I cannot recover from all borrowers these 9 millions. So technically, operationally, this should be kind of hard to do. So actually bank cannot charge additional payment to have this money back. So could be an instrument or a tool could be borrow directly to the central bank to increase the reserves. 5. You take $100 you had kept under your mattress and deposit it in your bank account. If this 100 stays in the banking system as reserves, and if banks hold reserves equal to 10% of deposits, by how much does the total amount of deposits in the banking system increase? By how much does the money supply increase? So here we have our situation at the bank. When you go to the bank and then they keep 10% of deposits, so it means that you automatically provide this 100, it goes 10 to reserves, and it goes loans to it goes the 90 to loans, and the other side should be the deposits of 100. Remember that the multiplicator is 1 over reserves. As the multiplicator is still 10, definitely if you provide 100 to the monetary system, you will generate an increase in the money supply of 1000. 6. Happy Bank starts with 200 in bank capital. It then accepts 800 in deposits. It keeps 12.5%, 1/8 of deposits in reserve. It uses the rest of its assets to make bank loans. So then, show the balance sheet of Happy Bank. So here is the situation in Happy Bank. We started with a capital of 200, but we know that if we provide this capital 200, then we receive, or we're going to have now 200 more in the assets, because we need to keep all the time assets equal to capital plus liability, the general equation of accountability. Then we have this one, the reserves. Now we have 200. When we receive our deposits of 800, it increases liabilities, and as a consequence I will have, if I keep 12.5% of these deposits as the example says, then I will go 100 to reserves and loans plus 700. But actually I wonder, it could be one way to understand this exercise. What I think, it's okay, because it says here of these deposits in reserves, right? So maybe this should be like kind of okay, deposit reserve. But I wonder if I think that this, with these deposits of 800 plus the 200 that you have before, at the end of the day you have with deposits 1000. So then the 12.5% of 12,000 should be reserves 125 and loans 975. The second situation that I presented to you is a situation that definitely you will provide more money to be available to be lent. Well, from my point of sight, I guess that for both sides they're okay, depending how you provide, like how you explain it, basically. Then, what is Happy Bank's leverage ratio? So the leverage ratio, as we saw during the chapter, is defined by the assets over capital. And then we have before and after. Before, we have leverage ratio of 1 because we have assets 200 and capital 200. And after, due to the increase of assets of 800, so we have 1000 and capital 5. And capital 200, it provides 5 as leverage ratio. Suppose that 10% of the borrowers from a Happy Bank default and this bank loans become worthless. Show the bank's new balance sheet. So when it means default, it means no payment. So then we have capital here 200, we have the reserves of 300, deposit 800 and loans 700. Then definitely these loans 70, they don't exist anymore. This 10% it doesn't exist anymore because they are now in default. And then you will affect immediately the capital. Why not liabilities? Because liabilities, this is the money that you need to respond for the initial one that they have their 800. You cannot go and say to the guy that deposited to your bank, I need my money back. And you say, well, I lend your money to another guy and he defaulted, so I cannot you pay anymore. Well, this is not a case. You cannot do something like that. So for this reason, it affects immediately your capital. In this case, should be like your income. This is a loss, and then you have as a consequence. This is your balance sheet. By what percentage do the bank's total assets decline, and by what percentage does the bank's capital decline with change in larger y? So change all the time we can find with the formula assets 2 assets 1 over assets 1. So the final value minus initial value over initial value, and then should be this one. And then we have faced a decrease of 7% in assets. In capital, exactly the same. We have 170 minus 200 over 200. So then a decrease of capital of minus 15%. So why is large the one of the capital? Well, definitely because my capital was lower. So when we have an impact in this case, so an impact of the same quantity in assets, this is a higher impact in the capital. So this is something what happened related with the crisis of 2008, when was immediately a change in the capital due to a dramatically decrease in the assets of the banks. Okay, I hope it has worked. I hope you have understood better these exercises. And as always, if you have any comment, you think maybe something got wrong, please tell me. I hope not, but sometimes it happens. So see you next video, subscribe, and bye bye.